The Revenue Mobilization, Allocation and Fiscal Commission has clarified its position on the ongoing tax reforms in Nigeria. The NIA report that it opposes proposed changes. While acknowledging the potential challenges and complexities of the reforms, the RMAFC has reaffirmed its commitment to working with the government to ensure a fair and equitable revenue allocation system. Well, in this conversation, we'll dive into the RMAFC's perspective on the tax reform bills, the potential impact of the proposed changes, and the challenges and opportunities they present for Nigeria's fiscal future. Joining me for this, I have right here with me Kenneth Erikume, Partner, Tax Reporting and Strategy, PwC. Thank you so much for joining me today.
Thank you, Perpetua, for having me. I'm looking forward to our conversation.
Absolutely. Well, we had an initial publication. We're told it's a 9-page memorandum. But now we're hearing that, okay, yeah, we didn't quite mean it that way. But for you, looking at some of the things we saw from that 9-page memorandum, what's your reaction to the legal, technical, and constitutional, questions that were raised?
Yeah, thank you very much. I think...
Maybe I should start by saying, did you see that coming?
Well, no, I didn't see it coming. I mean, I'm not a psychic, so I don't see everything coming. But the reality is that the RMAFC, that's the way we pronounce it, interesting acronym, they actually are a very important institution and responsible for allocation of revenues that accrue to the Federation account. So they play a pivotal role to monitor the revenues and ensure equitable distribution. And they're a product of the Constitution. And the Constitution also gives them powers to look over that from a Nigerian perspective. The challenge with the VAT situation is that, I don't necessarily believe that that constitutional provision requiring them to have an input and take the proposal to the president, for the president to lay it before the National Assembly, is required in the VAT context. And the reason for this is that, the VAT, as it's currently constructed, is not in the exclusive list, it's not in the concurrent, which means that VAT falls in the residual. And that's one of the things that Rivers State was actually challenging. They had actually won at the Federal High Court, gone to the appeal court, and they won, and they were taking it to the Supreme Court to establish that Rivers State should be responsible for administering and collecting its VAT revenues, because VAT is a state tax. And therefore, the construct of equitable sharing of VAT revenue in my view, doesn't fall within the purview of RMAFC. RMAFC would be instrumental, and I think that the subsequent communication from RMAFC expresses that viewpoint, because as an institution, they have history, they have historical context, and they should have data. How much of that data they have, I don't know, to be able to provide some constructive input into some of the conversations people have been having around the derivation and sharing for VAT revenue. So to that extent, I believe constitutionally and legally, I do not think it's within their purview. The current construct of VAT revenue sharing is actually in the VAT Act. And it recognizes that VAT is not even a federation tax per se. It allocates 15% cost of collection to the federal government, and then the rest is shared between the state and local government. So to that extent, even now, RMAFC has no input into that sharing formula.
So what you're saying is, that memorandum was unnecessary, or even its rebuttal was not necessary?
I don't think so. I think debates and conversation is always important. And the reason why is because VAT on its own is political. Right?
Absolutely.
Which means that you must carry every stakeholder along. Considering that this special construct of VAT is not the normal design. For example, CIT, Companies Income Tax, goes into the Federation account. RMAFC then has that sharing formula, and that is how it is distributed. VAT is a state tax, and its sharing formula is in the VAT Act. And historically, just to come, close to what the Committee on Fiscal Reforms is thinking. Historically, VAT was filed by taxpayers based on branches. But when the FRS design or structure for their tax offices changed, we now had the integrated tax office, which meant that someone with branches everywhere could just file its VAT return in one location. And then if you're using derivation as the basis for sharing and they're filing in their head office, then it will not be equitable. And I think that this is what the Fiscal Committee is trying to address. But like I said, it's a state tax, but it's collected, federally, and therefore the conversation and inputs from different stakeholders is actually key. So you can't just leave it and say, okay, the conversation is not necessary. I think, their contribution is necessary, and the rebuttal is actually necessary, because for you to land on consensus, you actually have to debate.
All right, so like what you just said now takes me to the next. The RMAFC sort of outlined 3 major issues: the constitutionality, which we've sort of addressed. Maybe we'll get a constitutional lawyer to take it further, right?
Yeah.
And then fairness and equity. I'd like us to stay on fairness and equity. Now, the Commission argued that arbitrary percentages could create perceptions of favoritism, particularly towards states with higher corporate activities or VAT collections, neglecting less developed regions and threatening national unity. The first argument for me, I don't think that one sort of works, because, we have a situation where when you look at that new derivation formula, you find out that, Lagos, that used to have all the headquarters and had the attribution to a very large extent, will probably have a reduction. That's when we look at that simulation that was done. So that argument, that one is put aside. But the other argument, that's the one I want us to look at, which is neglecting less developed region. Does that percentage, 60, 20, 20, that's derivation 60, population 20, equity 20, does that percentage or that construct sort of, maybe neglect the less, developed regions?
Yeah. I think for you...
Yeah, does that mean yes?
No. Yeah, in like, saying that I want to answer your question.
Okay,
but not that, not that there's anything wrong with the formulas. Between you and me, I think for you to say something is arbitrary, you must come with data and facts. And I think the Fiscal Committee, Fiscal Reform and Tax Committee has come up with data and facts.
All right, while you're talking, I don't know if you can have some of those slides that talk about, this formula.
Absolutely.
And maybe another slide, the one that talks about the simulation. If we can have all of this on the screen, that would be very good, so it can help the conversation. Yeah, go ahead.
Absolutely. So for them to come up with that formula, the formula they've come up with, they have looked at data, and they have said what would be equitable when we put this data through a simulation, like you said, using those factors. And the result, based on what they have shared, seems to show a more equitable distribution. For someone to then say that that is arbitrary, you must come with a more credible information or data, not a qualitative...
Show workings.
Yeah, you must show workings, essentially, and show why it is not equitable. So in my view, based on the results and the analysis done by the Fiscal Committee and Tax Reforms, I believe that those formulas are equitable. It's not that there cannot be improvement, because one of the conversations that has come up, particularly in terms of certain regions that are not heavy in terms of industrial activity or service activity, but they are high in agriculture, is that when you zero rate for VAT purposes, then potentially they could find themselves in a result where they're in a position where they're not generating a lot of VAT revenue.
Because what comes from them has been zero-rated.
Zero-rated, essentially. And therefore, I think to deal with that, then it must be that the derivation also considers zero-rated inputs, right? To look at, even though the products from your region have been zero-rated, their values are captured.
But don't they
and
also
from
consume these other things in those places?
Yes, they do, but you see...
But there should be more for production,
there is
right?
consumption, and then there's production.
Production.
There are some places that consume and produce. You see what I mean? So if you look at Nigeria as a construct, from a global perspective, we are consumers, right? Because we import a lot of things. So if you have a VAT that is looking at, production and consumption, you'd only be able to give us some credit for consumption, not much in terms of production. So it's important that, while we're looking at derivation, what is being derived from that region, we are looking at both VAT-able products and even exempted products and zero-rated products. Otherwise, it will lead to a result that will not be equitable. And I think that these are the sort of conversations we expect. Debating the numbers, presenting numbers, and like you said, showing the workings to ensure that we are actually debating based on facts rather than sentiments. And for me, I think that that's key.
Okay, so deal with that production issue and then the zero-rated or even VAT-exempt products or service products, actually. What do you think should be the way forward? What are your own, suggestions? How do we solve that?
No, it's very simple, really. I think I alluded to it when I was speaking. The VAT returns should capture the products, whether they are VAT-able or not, the value of whatever is happening in that in that region. It should be inputted into the VAT returns, captured, and used as the basis of the derivation calculation. So not just the VAT generated from that region. So you go to the sales, the output from that location, which will be in the VAT returns anyway, and that should then be the basis of the calculation. As far as I'm aware, the committee has not said that that's not the approach they are going to take, but it would be useful to have clarity from them that will be the basis. And I think that would then give, further comfort to some jurisdictions that feel like, okay, my product is zero-rated, I'm largely consumption and all that. But over and above that, I think there's the important bit around tapping into the potential of the states, which is very key. And what I tell people essentially is when you look at other jurisdictions that have a federal system, for example, the United States, and I think, if you allowed me to design the tax process for Nigeria, I would go in that direction to a large extent, because you need states to be able to come up with their tax rates as well for fiscal competition. But I think that is a few years further than the reforms which we are having now. But the idea is that states should be able to say, this is the VAT rate applicable to my state, this is the PIT rate applicable to my state. And that's why you have states in the
Don't
US
you think, does that sort of deviate from what the fiscal and tax reform committee is currently doing?
Yeah.
Don't you think it sort of deviates from it?
Yeah, it deviates from that, but I think it's a step up, right? And for me,
I don't think... We're not even done with what we have here. You're suggesting something else.
I don't think you can go there without dealing with this and having technology as well, right? In order to administer it properly. Okay. But that's when you have full information, you have data around the taxpayers and their economic activity. The FRS is currently going through a process where they want to implement e-invoicing and fiscalization. It means that when transactions are happening in the economy, when someone has an output, when someone is selling, it is actually an input for the other person. It's actually an expenditure for the other person. So they're able to capture the full value chain of what's happening in the economy. When you have done that, you can then go into the next phase of fiscal reforms, where you're now saying states should be able to set their tax rate for personal income tax and for VAT. That would then give them the robustness to be able to compete.
Actually, for example, competition.
Ogun State can then say, my PIT rate is lower than Lagos State, and attract more people to go there and live there and open up industries there as well. So, so that's the future.
That's the future. Kenneth, it's always a pleasure speaking with you. And I hope we'll have this conversation some other time. Maybe after the whole drama around the tax is over, we'll then have our own conversation, which is about the next step. Thank you so much for coming on the show today.
Thank you, Perpetua, for inviting me.